Good morning, everyone. Thanks for joining the weekly research morning call. Today, we have quite a few stock counter updates, followed by the Euro technical pulse and Singapore weekly. So without further ado, I'll hand over to Ambrish to talk about blocks. Ambrish, please.
Thank you, Nana, and good morning, everyone. To start with the Block's third quarter 2024 results. So, overall, basically, Block is a fintech company and it operates through two segments, Cash App and Square. So, Cash App, it basically offers peer-to-peer payment solutions, banking and investment solutions to consumers, whereas Square, it basically provides payment processing solutions to merchants. So overall, the revenue came in within our expectations, whereas PATME, it was ahead mainly because of high operating leverage. In terms of positives, the gross profit for the company, it grew by about 18.5% and year on year, and this was basically outperformed the company's guidance of 17%. And this was mainly because of continued strong demand for its Cash App segment. The Cash App number of users, they grew by about 4% on a year-over-year basis to 57 million. Whereas it also reported a strong user engagement, like the number of debit card users, it grew by about 11% on a year-over-year basis. Second positive is that the adjusted PATME for Block, it grew by about 77% on a year-over-year basis. And this was mainly because of the high operating leverage. Like for instance, its operating expenses grew just by 1%. And this is mainly because of continued cost cutting initiatives like job layoffs and real estate consolidation. In terms of negatives, the Square, it reported the gross payment volume, it trend of further decelerated. So the GPV for Square, it grew by about 7.5% in the third quarter as compared to 11% in the third quarter of 2023. And the drop, it's mainly because of a lower same-store sales growth as well as a lower consumer spending, particularly in food and retail categories. However, for the fourth quarter, company said that in the quarter to date in October, so it saw a positive GPV trends for Square segment, and as a result, it expects the gross profit to grow by about 14% on a year-over-year basis, whereas the profitability adjusted operating income is expected to grow by 92%, mainly because of high operating leverage. So overall, in terms of valuations, we maintain our buy recommendation with a slightly higher target price of $105 as we increased our adjusted PATME by 5%, mainly to reflect lower expenses. Next slide, please. Thank you. So moving on to Airbnb's third quarter results. So overall, the results, it exceeded our expectations mainly because of strong summer travel demand. The top line grew by about 10%, and this was mainly because of the 9% surge in its booking volumes and modest growth in daily rental rates. So in terms of positives, the company highlighted that the booking volumes in its emerging markets like Latin America and Asia Pacific, the growth rate for these markets, they nearly doubled as compared to its core markets like US and UK. The booking volumes in Asia Pacific was up by about 19% on a year-over-year basis, whereas Latin America, it grew by about 15%. Second positive is that the listings continue to grow on Airbnb's platform. For third quarter, it grew by about 14% to 8 million. And we believe that this is mainly because of continuous product innovations and providing support to hosts like co-host feature and Airbnb rooms and other pricing tools that basically help hosts. And secondly, apart from the listings growth, it's also focusing on improving the supply quality on its platform. So it removed about 300,000 listings over the last year, mainly which did not meet the guests' expectations. And it also included recently added in features like guest favorites, and also the superhost managed bookings, they were up by about 21% on a year-over-year basis. But however, despite these, the negative is that the earnings in the third quarter, they dropped significantly by about 67%. So there are two reasons for this. First of all, the operating expenses, they grew by about 21% on a year-over-year basis. and this is mainly because of higher sales and marketing expenses, as they like invested into the emerging markets or spent into the marketing tools to create more aware brand awareness in the emerging markets. And secondly, there was a one time tax benefit of about 2.8 billion US dollars in the third quarter of 2023. So excluding these, the adjusted PATMI dropped by about 15% on a year-over-year basis. In terms of outlook for the fourth quarter, the company expects revenue to grow by about 9%, and it said that booking volume trends, they have now normalized, and as a result, the short and long lead times, they have also witnessing strong demand trends, whereas margins are expected to continue to contract mainly because of higher spends into the product development and sales and marketing expenses. But overall, for Airbnb, we have downgraded from neutral to reduce recommendation, mainly because of the recent share price gains and also valuation concerns. Like Airbnb, it's trading at almost 31 times the forward 2025 1 year forward PE multiple, with earnings expectations for 2025 at just about 11%. So we believe that the valuations are expensive as compared to the overall market and its other peers like Booking Holdings and Expedia, which are at fairly trading at about 20 times or for the FY25 multiples. So overall, we have a reduced for Airbnb. Next slide, please. So I will cover Spotify on behalf of Jonathan. So overall, the results were within our expectations, with 9 months 2024 revenue and PATMI at 74 and 62% of our full year forecasts. So in terms of positives, the monthly active users for Spotify, they bounced back in the third quarter after the miss in the second quarter of 2024. So basically, both the total monthly active users and premium subscribers, they beat the guidance estimates by about 1 million each, and they grew by about 12% on a year-over-year basis. And this is mainly because of high marketing efforts. And secondly, the gross margin for Spotify, it expanded by about 470 basis points in the third quarter, and this also came in ahead of the guidance of by about 90 basis points. And we believe that this is mainly because of lower content costs, and the majority of this contribution came from the premium gross margin segment. And this is mainly because it has a pricing power. And lastly, the company management highlighted that there is still more price increases could be there in FY25. So in terms of outlook for the revenue, it's expected to grow by about 12% in the fourth quarter 2024, with about 10% growth in its monthly active users. It's expected to add about 25 million new subscribers in the fourth quarter on a year-over-year basis. Whereas in terms of valuations, we downgrade to accumulate from buy mainly because of share price gains, whereas we increase our target price from 420 to 485 mainly because we have increased our FY25 PATMI by about 9%. And overall for Spotify, we remain positive mainly because it has pricing power, as well as the margins have been expanding, and also it's expected to generate substantial free cash flows. So that's all for Spotify. Next slide, please. So I will just quickly run through a Magnificent Seven on behalf of John and Helena. So basically, for the month of October, the Magnificent Seven stocks, they were more or less flat as compared to the overall market. Like the S&P 500 and Nasdaq 100, they both were down 1%. So basically, the main biggest gainer was Nvidia, and this is mainly because the stock gained after the AMD results. It showed that there is still continued demand for the AI infrastructure, whereas Microsoft was the biggest laggard, mainly because of it provided a soft revenue outlook for the December ended quarter. So overall, the performance was mixed, and mainly because the 10-year Treasury yields, they rose by 50 basis points, and this negatively impacted the overall stocks. Next slide, please. So this is just a recap or summary of the September ended quarter for the Magnificent Seven stocks excluding Nvidia. So most of the stocks, they either beat or they were in line with estimates. Only Tesla did not meet the expectations, mainly because of lower deliveries. Whereas the growth expectations for Apple were not that high, with iPhone sales expectations of growth of just about 2%. So mainly the fastest growth came from the digital advertising segment, like the Meta and Alphabet. So both of these, they grew by about 19 and 15%, mainly because of strong demand for digital advertising. So they basically witnessed so the key drivers were basically consumer spending. It remained resilient, as well as the ad prices were high, and also there was a better monetization for AI enabled products. Whereas Microsoft's revenue, it grew by about 16% on a year basis, and this was mainly driven by demand for its cloud service, which is Azure, which grew by about 33% on a year basis. Whereas for Amazon, the e-commerce spending, it remained resilient, whereas its cloud service, which is AWS, it grew by about 19% on a year basis, and AWS 19% growth was the fastest in last 7 quarters or so. So, and the Apple iPhone growth, sales growth, they grew by about 6% on a year basis, and they beat the estimates by about 1.6%. Whereas Tesla missed the expectations, mainly because of lower deliveries. And in terms of outlook for the December ended quarter, so there is a moderating growth rate, like it expects like a growth of about 8%, and we believe that this is mainly because of tough year-over-year comparisons. Next slide, please. So moving on to the individual counters. So we'll just briefly run through the news apart from earnings. So for Alphabet, it had signed a partnership with Qualcomm, and basically to generate new generative AI solutions for car solutions. And so it basically like plans to create experiences like intuitive voice assistants, immersive maps, and real time updates to driver needs. Whereas Nvidia, it said that there is still high demand outside the US, and data center provider in Japan is likely to provide a significant order of about 50,000 to 100,000 NVIDIA GPUs. Next slide, please. So for Apple, there was a news that there was a strong adoption for its 18.1 iOS as compared to 17.1 iOS, and the adoption rate, it's nearly double, mainly because of its new generative AI features, like it can create or generate advanced writing capabilities, as well as upgraded Siri. And there was also a media report that iPhone 16 sales, they have surged nearly by about 20% in China in the first 3 weeks of October, as compared to the iPhone 15 models in 2023. But overall unit sales, it fell by about 2%, and this is mainly because of lower sales for its other iPhone models. Whereas for Amazon, it witnessed a strong demand for its Prime Big Deal shopping deals in October, and it was the biggest event wherein the users, they nearly saved by about $1 billion in deals. So that's all for Amazon. Next slide, please. So for Microsoft, apart from earnings, was that it had signed a deal with Constellation Energy for a 20-year deal, wherein it would restart the nuclear power plant in Pennsylvania, and the plant would basically provide a carbon-free electricity which can support its data centers, and this is in line with its sustainable strategy. But the plan is, it's expected to open up in 2028, and it still needs pending approval, regulatory approvals. And also, last month, it introduced autonomous AI agents, which can perform routine tasks, like it can update support tickets or generate sales leads. But the pricing, they are yet to announce. And this would basically directly compete with Salesforce AI agents, but this can enhance the company's capabilities, but competitive position, but not expected to be a revenue contributor in the near term, mainly because the companies would still focus on adoption, and whichever a product can create better tangible benefit to its users would be the gainer. So that's all for Microsoft. So to conclude for Mac 7, we basically maintain our overweight recommendation mainly because of a strong demand for digital advertising, whereas continued strong demand for the GPU as a service from cloud services like AWS, MSFT, and also the EV demand in China has been picking up, and iPhone sales for the third quarter they beat expectations. So overall, we maintain our overweight on Magnificent 7. So that's all for me. I would now like to pass it on to Iqbal.
Thanks, Ambrish. Now I'll be presenting on Centurion. Centurion released their third quarter update, and in this update itself, no earnings numbers is being provided. However, they did give us revenue numbers, so their 9-month 2024 revenue exceeded our expectations. It is 78% of our FY24 forecast. And their revenue growth is driven by very high occupancy rates and rental rate reversions across all their segments, mainly their student accommodations and worker accommodations. For example, the occupancy in Singapore worker accommodations is 99%, and this is already the highest possible value because it's not possible to reach 100% due to natural attrition. And for their positives, there is a pipeline of number of capacity expansions, and the number of beds is expected to increase in the near term. For example, there's more than 2,000 worker accommodation beds expected by the end of this year, and this increase in number of beds we will expect to see a gradual ramp up of revenue because it takes around 6 to 9 months for the beds to reach their ideal occupancy. So we will likely see revenue coming in the later half of 2025. As for their interest cover ratio, this ratio is EBITDA divided by interest expense. It increased 32% year on year. Last year it was 3.4, and this year it was 4.5. So this shows signs of increased profits, and it may also be because of lower interest expense due to the cut in Fed funds rate. As for our outlook, we raised our FY24 revenue estimates by 3% and PATMI by 9% respectively. And we maintain accumulate with a higher target price of $1.02. Previously, it was 90 cents. And we do expect further revenue growth and further cuts in Fed funds rates to drive their bottom line profits growth. Because for every 50 basis points cut in Fed funds rates, we estimate that it can raise PATMI by around 3%. Yeah, that's all from my end. I'll hand over to Darren. Thanks.
Hey, thanks, Ipan. I'll talk about Prime US REIT's the quarter business update. Yeah, so for our distributable income, it was in line with our estimates. It was lower, but that's mainly because of a few reasons. So one of it is lower occupancy. Another one is because they divested One Town Centre back in July 2024, so the absence of contribution from One Town Centre. And they also had some AEI works at Waterfront and Washingtonian, because previously one of the tenants left, so they took some time to just do some AEIs. And of course, they're impacted by higher finance expenses as well, because over this past quarter, they drew down some RCF to fund the capex of, and especially for this Waterfront at Washingtonian, and it also coupled with some higher interest costs. Yeah, so for the positives for them, the leasing volume is spiked 116% quarter on quarter, so it's really strong leasing volumes. It really is picking up from what we see from the stats, pure numbers. So the 9 months also up 73%. And all these leases were done at 6.5% blended gross rental reversion. So it was driven by 101 South Henley as well as the Waterfront at Washingtonian, which is currently 40% occupied. So over the third quarter, the occupancy increased by 7 percentage points. And by year end, it's expected to lease up another 10%. So that will bring Waterfront and Washingtonian's occupancy to 50%. And on top of that, they're also in discussions to lease up more of the building with some large tenants interested. And across the portfolio, they are also in major discussions with 4 separate large tenants, and all of them are looking or requesting for more than 60,000 square foot of space. So these signs are promising. But right now, portfolio occupancy is still relatively low, 83%. But we think this will start to pick up over the next few quarters and over the course of 2025. Yeah, so for the negatives, right now, aggregate's leverage it increased to almost 48%, but that's mainly because of the drawdown of RCFs to fund capex. So right now, they have about 64 million in cash that's sitting in the balance sheet. So they noted that this cash, like when they sign some leases, the tenants will look at Prime's balance sheet, the landlord's balance sheet, and when they see the cash, then and they see some strong balance sheet, then they will be more confident to take up spaces at the property. So if you exclude, or rather if you include this cash on a net cash basis, the leverage is at 45%. So they might so basically the issue for now for them now is the year-end valuations. So if valuations remain stable, then they do not breach this gearing, the MAS leverage limits of 50%. So that is the key thing to look out for. So the management for right now, they are still confident that they will not breach this gearing, the 50% limit. But for us, we think that there will be still some weakness because despite the lower interest rates and but possibly cap rates would have stabilized because from the lower interest rates. But we've seen some recent transactions, especially Manulife, that they sold some properties, sold one property at 30% to discount the valuation, and there's still lack of bank funding. So that we think there will still be some pressure. But fingers crossed they do not cross the 50% leverage limit by year end. And for this quarter, so the cost of debt it rose 4.5%. So it rose to 4.5%, the all-in cost of debt, and it rose from 4.2% because they refinanced the loan, 550 million new credit facility. So that really increased their interest cost. So as a result of this refinancing, we expect the all-in cost to rise to 5.25%, even though about 61% of their debt is still hedged. Yeah, so for the outlook for them, they will benefit from they still benefit from a flight to quality because their assets are really high quality and well amenitized grade A office assets across the portfolio. So like I mentioned, the breaching of gearing, that's a key thing to look out for the year end. And right now they have still not committed on future distributions going forward. So over the past half year as well as in 2023 year end, they paid 10% of distributable income as dividends. So that's we put that in our forecast as well. So we expect them to pay out 10% in FY24 as well as in FY25. So with that, we maintain our buy call, but we lower our target price because basically previously we did not factor in a 10% distributable payout ratio in FY 2025, but now we factored that in. Yeah, so as a result, the target price dropped to 20 cents. But right now, Prime is still trading at 0.27 times price to NAV. So that's a steep discount to NAV. We think there is room for capital appreciation because leasing is improving and hopefully valuations remain stable, and as well as the lower interest rates will all give a boost to their performance. And right now, when we assume a 10% payout ratio, the FY24 distribution yield is 2.1%. This is still better than the other US REITs who are not paying dividends at all. Yep, next slide, please. Yeah, so there's one more slide for me. Yeah, if I ask you to tell me what property or what assets these are, you probably tell me these pictures are from a 5-star hotel. But actually, these are the pictures from the waterfront at Washingtonian, the office building that just completed its AEI. So it really looks like a hotel and it's very well amenitized. So that is why the tenants are attracted to this high quality grade A office building. Like you see, there's even got a massage chair also, and a fitness corner and such. Yeah. Yeah, so that's all from me. I hand over time to Meow Meow. Thanks.
Thanks, Darren. So Lendlease released the first quarter 25 result last week, and no financials was provided. Something positive about them is their occupancy rate improved by 1.1% year-on-year to 75% at Sky Complex, as a new lease has been signed at Building 3. And L-Rate is in discussion with 2 more prospects from the education and co-working industry, which is expected to boost the occupancy rate to more than 30% upon the deal close. And the building received strong leasing interest as the leasing momentum on the recovery in Milan, with green certified building become the tenant's key selection criteria. And our REIT achieved a rental reversion of its retail segment of 11.4%, with GEM outperforming at high teens and Somerset at high single digit, as the major tenant renewed the list at a lower rate than the new tenants due to its large occupied space. And office rentals saw an uplift of 1.2%. We expect the reversion in 1H 2025 to be supported by at least 5% rental reversion from GEM's rental review in December 24. We believe the cost of borrowing has already peaked, and our rate will be relieved from the interest rate headwind from this financial year. And something negative is tenant sales decreased by 5.7% year-on-year in first quarter 2025, impacted by a strong Singapore dollar against neighboring currencies, which has eroded spending power of international visitors. Sales at GEM were also affected by the MRT breakdown for over a week, and sales might have matched last year's level if adjusted for the disruption. And for outlook, REIT is engaging with prospects on divestment of GEM office, which now valued at 450 million to 480 million, and is largely favored by in-state investor, given the long WALE and also stable income. Proceeds from the sales will be used either for redemption of its perpetual, which due in April 2025, or to pay the existing debt to lower gearing. Assuming the sales price of 450 million, we anticipate gearing to decrease by 8%. And Live Nation is still in its legal documentation stage, and we expect it to be ready for public by the end of 2025. So we reiterate our buy recommendation with an unchanged DDM back target price of $0.8. Our REIT is currently trading at FY25 dividend yield of 7.3% and also price to NAV of 0.76 times. And moving on to Zixin. They released the first half 25 result last week, and the revenue was within our expectation, although it only represents 36% of our full year estimates, but it's due to a seasonally weaker first half. Adjusted profit exceeded expectation after adjusting non-cash and one-off expense, and this was due to share-based compensation and also ResCom warrants issued in first half 25. And for positives, sales of fresh sweet potato products increased by 160% year-on-year in first half 25, as Zixin expanded its sales channel to supermarkets and also e-commerce. And the Liancheng country government also invested RMB 120 million to roll out warehouse for cold storage. And the shelf life extension and the spoilage reduction allowed Zixin to meet the supermarket's requirement for freshness and also consistent supply. We expect sales volume of fresh sweet potato in second half 25 to increase by around 110% year-on-year, driven by seasonal demand, as roasted sweet potato will be popular in winter, and also snack sales are likely to be boosted by the Chinese New Year. However, as part of the strategy to capture market share, we anticipate a slight decrease in selling price. And gross margin also improved by 3.6 percentage point to 33.2% in first half 25 due to reduced spoilage and also introduction of higher margin products. We expect the gross margin to increase further to around 34%, as the new high-tech manufacturing facility will begin operation from fourth quarter 25 onwards, focusing on higher margin products such as the purple sweet potato powder. And as for outlook, we expect seasonality to positively impact fresh sweet potato sales in second half 25. The harvest period is usually from late September to early January, which will enable distribution at the premium price due to its freshness, with customers generally favoring in-seasonal products. Additional revenue is anticipated to come from animal fees, with the first batch expected in fourth quarter 25, contributing to estimated revenue of 1.2 million. The new manufacturing facility for the production of higher margin products is expected to achieve an increase in productivity by around 60%, which we have yet to factor into our model. So we reiterate a buy recommendation with DCF back target price of $0.05. Zixin is trading at 7.3 times FY25 forward PE, with our target price indicating 12 times FY25 PE. That's all for me. I'll hand over to Ding for technical pause.
Thanks, Gamil. Good morning, everyone. We talk about the S&P 500. So last week we saw a pullback in the index, 2% pullback after the post-election rally. So currently it's retesting the previous horizontal resistance breakout level at 5,865. So we expect some sort of a rebound from this previous resistance, likely to turn support level, with immediate resistance at 5,950 to 6,020 and support at 5,785 to 5,878. So that's all from me now. I'll have time to Glenn to talk about the Singapore banking market. Thanks.
Thanks, Zane. Yep. So we'll be looking at the banking monthly. First, just a quick recap on the bank's results, the third quarter results. I think the main highlight here, for everyone looking at the news for the banks is that the trading income really surged, and that was the main contributor to the bank's very good set of results. Right? You look at the red bar here, you can see it's up, ranging 53% for DBS and all the way up to 135% for OCBC. This is really due to this high volatility that we saw during August from the yen carry trade, which really contributed to the bank's trading income. Apart from that, the other items that really did well was also the continued growth and recovery in their fees and commissions. So wealth management income was strong and it continued to grow, while what was a bit of a letdown and really quite expected is that the net interest margins and net interest income have been very flat or even down just a slight percentage. But overall, if you look at it, the PATMI growth was good. It's almost double digits across the board, right? And this was also really due to this trading income. Another point I'd like to look at would be the CET1. So CET1 is Common Equity Tier 1. Basically, this just shows the amount of capital, excess capital that the banks have, right? They're looking to hold not more than 14% of CET1. But currently, if you look at the CET1, it's all around 15%. This slight uptick, the one in the bracket would be the CET1 that was in the second quarter, whereas the one in the non-brackets is the third quarter. And this is really due to the new Basel IV, which bumped up the CET1 slightly, but UOB was the biggest beneficiary from this change in the Basel requirements, which they now CET1 is at 15.2%. Not surprisingly, OCBC is still the highest at 15.6, which means that they have around 1.6 percentage points of excess capital, and that equivalent to around 4 billion worth of capital. So we are hoping that they will be able to put back some of this capital. If they're not going to do an acquisition, then maybe give it back in share buybacks or extra dividends. So that's one of the upside surprises we could see from OCBC. As for DBS and UOB, they have both indicated that they will be doing share buybacks. DBS said that they will be committing to around, I think, 3 billion of share buybacks. No timeline yet or how long this will take or when it will take, but at least they gave a figure. So that's good. It can further improve their ROE and EPS. For DBS also, they said that they will be able to maintain their 24 cents per annum increment in the absolute dividends, regardless of whether or not their dividend payout ratio goes above 50%. So that's a very good positive for DBS. But for UOB, they did say that they will be actively trying to manage their excess capital. So that's also good news. They can be more aggressive in their own words. So we could possibly see some form of special dividend, or also share buybacks, and this will be a good surprise for UOB, which also is one of the reasons why, their share price did surge a bit slightly after their results. So that's all for the bank's results. Now moving on to the usual stuff for the banking monthly. We'll be looking at the interest rates. Interest rates were down, which is to be expected, with the rate cuts kicking in and the second rate cut also coming in, right? We are expecting it to continue to decline in tandem with the Fed rate cut. So we could possibly see rates, going down even further as we move into next year. But now, the expectations are fewer rate cuts due to the Trump's win. So we could see rates, stabilizing sooner rather than later. And this is, of course, beneficial to the banks because then, their NIMs and net interest income won't be as greatly affected. Now, moving on to the next slide, we're looking at the loans growth. So loans growth has been very positive. It has reached a 24-month high. It's now at 2.7%. It has been lagging, for the last almost a year, right? If you look all the way back, the last time it was at a positive, it was back in December. No, not even December. Sorry, like November 2022. And once the rates went sky high, right? The loans growth has been in this like decline ever since then. So this is a good sort of indicator of where loans will be going. We did see loans growth, tick up slightly the last few months, even though rates were not really cut yet. But now, we are seeing this much more positive increment, 2.7% as compared to like 1+% the last few months. So going forward, I believe that it could possibly surpass the mid-single digit mark. We could see mid to high single digit loans growth going into next year when rates start to drop more. So although rates are now expected to drop slower than previously, but it will still definitely decline and get off the highs that we have seen. Yeah. For the deposits and balances, it continued to grow by 3% year on year. But more interestingly is that the current account and savings accounts proportion rose to 18.4%. Yeah, it was hovering. It could never breach this 18.3% for the last, I think, half a year. But recently we have seen this slight increase to 18.4%, coupled with the increase in deposits, which indicates that the fixed deposits are sort of the high interest fixed deposits that investors and consumers park their money into a year ago are starting to mature, and they're coming out, right, of the deposits, fixed deposits. So they are putting it back into the current account, savings accounts, or even back into the investment products. And this is very beneficial for the banks because fixed deposits have quite a high cost, high deposit costs, high cost of funds for the banks. So once it shifts out, it means that the banks can lower their deposit costs, which will help to improve their net interest margins. And we could see net interest margins maybe not declining that much. Yeah, sorry, there's no slides on deposits. I'm just reading off the slides. Yeah, we couldn't put it in. Yeah, so that's one of the positives, going into next year as all these high interest fixed deposits mature, and then they get placed back into lower interest CASA or fixed deposits, and this will be beneficial for the bank's net interest margins and back also to their net interest income. Now moving on to the next slide. Yeah, this is the SGX statistics, their monthly statistics. It's quite a positive note, which also it is a good indicator of how SGX's performance and earnings will be like, for the coming half. So they only do it half yearly. If you follow SGX, you can know that recently their share price has actually spiked up a little bit, and this is mainly due to almost all their volumes actually performing well. The main tool we look at are the Securities Daily Average Volume, or SDAV, which surged 36%, as well as the DDAV, or Derivatives Daily Average Volume, which also rose 48%. Right, this is mostly due to the heightened volatility. So volatility was up to 20 in October. We use the VIX, which is the market index that measures the implied volatility of the S&P 500 index. It's up from 17.7 the previous month in September, and this is really due to this a lot of the questions surrounding the US elections. So the volatility did spike up a bit, which benefited SGX's volumes. And also the top 4 equity index futures turnover was also high, mainly due to the FTSE China A50 index futures having higher trading volumes, mainly due to the China's Golden Week holiday. So all in, I think this will be quite beneficial for SGX in their coming the next half when they release their results, because all these volumes means better revenue and then better earnings as well for SGX. Now, moving on to the next slide, we'll be looking at the bank's performance. So local banks share price performance was quite muted. The growth was only up 1% in October. Again, DBS was the strongest with the increase of 2%, while OCBC and UOB were at 1.5% and 0.3% respectively. So this is for October. So just to clarify. And this was quite muted in October, mainly due to a lot of the investors waiting on the sidelines while they wanted to see how, firstly, how the third quarter results were like, whether it's a good set of results. And also, secondly, I think they were waiting to see for the results of the US elections and where interest rates, what the direction of interest rates will be, right? So, if Trump won, then definitely they'll be looking at a slower interest rates cuts kind of environment, and if Kamala won, they'll be the opposite, right? So the reason, if you look at November, at least in the first half, you can see the bank's share price has all spiked up. So for November, we could be seeing a very good, healthy recovery. And this is due to, again, the two reasons, which was that the third quarter results were very good. And secondly, also, with Trump's win, now the expectations for rate cuts is much lower, right? So those are the two main reasons. And I think the banks have the share price have all ran due to those two reasons. Now, moving on to the next slide. So my ending slide is that however, we still do maintain neutral on the banks, mainly due to the recent share price run up. We're not sure if there's as much room more to grow, but we are still positive, looking into the lower rate cut expectations going into FY25. So the banks will benefit from this as the decline in the net interest income and net interest margins will soften. And furthermore, the continued double-digit fee income growth, as well as a loan growth recovery from the rate cuts will help to boost their earnings. And more importantly, there's also a further upside to their dividends as the banks will look to actively manage their excess capital of around $2 to $4 billion. And this will mean either higher dividends, special dividends, or a possibility of share buybacks, which will help to improve the bank's ROE as well as the EPS. Yeah, so that's all for the banks. Now let me move on. Yeah, so Paul is not around. He is out for investor briefing. Analyst briefing. So I will try my best to step in the shoes and cover his counters as well as the macro at the end. If you have any burning questions, I will try my best to answer. But if you want to have your question answered more succinctly, please put it into the P3 app and address it to Paul, and he'll get back to you on the app. Yeah. So we'll start first with Singtel. Yeah. For Singtel, the results were within our expectations. Both the revenue and the forecast were within our revenue and EBITDA were within our forecast. And the positives was actually essentially just Australia, right? And the asset monetization. So in Australia, if you look at the table on the left, you can see that the revenue growth was starting to recover. It's quite small. For Australia wise, it was 3%. But it's starting to recover because the mobile prices in Australia has started to rise. But this was only effective early September. So if you look in the following quarter, you'll see most of this recovery coming in. So the next quarter should be even better for the Australia side of Singtel's results. Margins have also expanded by 10%. This red box here, yeah, for Optus, mainly because they took out I think 10% of their hits or something. Yeah. So I don't think Optus have ever done this before, but they have started to they cut their operating costs, right? So they started this $200 million per annum cost cutting, and they're starting to take it out. A lot of the cost is mainly coming from Optus, hence you see this margin improvement. Yeah, but however, the weakness has been on the Telkomsel. So for Telkomsel, you can realize that the earnings is almost down 28%. You look at the regional associates, it's down 28%. And this is mainly due to the rupiah, which is the depreciation of the rupiah, which sort of dragged down their results. And also they do have quite a lot of competition in Indonesia. and they have invested a lot in fiber, so that's also dragged down quite a bit. But there should be some recovery moving forward, but because the improvement, the investments into the fiber has sort of completed, so we could see some improvement going forward into the next quarters. Another sort of a negative would be the quite huge spectrum payments that they have done. We didn't put the numbers here, but they are going to, I think Optus said they're going to come out to pay about 1.3 billion for a 900 megahertz spectrum, and Singtel is also going to pay about 400 million. So, for the 700 megahertz spectrum in Singapore. And, I think the view is that the spectrum doesn't really contribute. It improves the capacity, but we look at the bottom line, they can't really price their product higher due to this additional capacity. So it's really only good for differentiating themselves, right? But we won't really see the effect on the margins or pricing. So we do maintain our cumulative recommendation and also the target price of $3.44. I think the two main catalysts for Singtel right now will be their cost-cutting effects. I mentioned earlier the 200 million per year over the next 3 years, as well as the monetization of their assets. So monetization of assets, they have around 6 billion of assets that they intend to sell. It will be divided up among all their associates. So, they didn't really they did mention a bit of the name, so it's a bit InTouch, Comcenter, as well as Batiatel, but of course the timing wise was not mentioned. Yeah, so that's all for Singtel. Let me now move on to Valuetronics. Yeah, so for Valuetronics, the earnings were also within our expectations, the profit was a bit better than expected, mainly due to higher gross margins as well as the lower effective tax. So the one positive thing was that their margins were at a 4-year high. If you look at the red box here on the top, yeah. And this is they are really a contract manufacturer, and most of their facilities was in China, and their earnings have actually been coming down in the last 5 years. However, this year they have started to recover, and this also shows in their margins is mainly because they have started a plant in Vietnam, and they have transferred most of their customer orders through Vietnam. So margins are improving because they noticed that the consumer electronics or CE portion has been improving. That's why it has went down. So all these low margin sort of products have sort of come off. And I think the main one is that they are also having very healthy cash flows. They generate around 200 million of Hong Kong dollars of cash flows compared to the 80 million that they are paying out in dividends. So that's a very good plus for Valuetronics. And for the one negative is that the contraction of the revenue, we believe that it will still persist. It will probably stabilize in the coming quarters, mainly due to most of the contraction of this revenue is coming from the consumer electronics. So, but however, we do believe that it should stabilize in the coming quarters. We did raise our earnings marginally due to the better gross margins and also lowered the effective tax. We have a call which we maintain, as well as the target price of 78.5 cents. Yeah. For the outlook wise, the growth drivers is mainly this 4 new customers that they announced around 6 months ago. So one of them has kicked in already. However, the volume ramp up from the rest is still a bit slow because of the macro conditions. So that would be one of the key drivers, when these other 3 new customers volume ramps start to kick in. And they have also starting to look at the GPU as a service. It's like what I think Singtel is doing, where you sell GPU processing power as a service, and mainly they're doing it because the demand is quite strong, right? And that they believe that they can eventually commoditize this. So they're also providing AI services, but it's through a partner, not directly through them. So they need some technical help or AI specialty to do this. And we are not really factoring the earnings from this because it will not very likely be it will be a positive contributor, but we're not sure for how long, mainly due to the shortage of chips. But yeah, we're not factoring it because they haven't given any numbers. But they did say that they're going to invest around 200 million Hong Kong dollars into this venture. So that's all for Valuetronics. Let me move on to the next one, which is we have 2 more counters. So the third one will be ComfortDelGro. Again, it was within our expectations. It's at 75%. The PATMI was at 75% of our forecast. Most of the organic growth is from the UK. So you see the spike in the earnings there. As you notice here, in the left here, you can see that UK actually had a 262% hike in earnings, right? In EBIT. So this is mainly due to the recontracting of their London bus routes, which matures every 5 years. So 5 years ago, the competition was extremely aggressive with very low low to mid-single digit margins. But now they're being able to bid back contracts, and they're able to get margins of around mid-teens to low mid-teens. And the second one is Australia. So this is a negative. If you look, earnings are still sliding. You can look at the second red box here. Year on year, the EBIT is down 19%. And this is mainly due to the bus driver shortages. Yeah. So we do maintain our target price, of $1.63, but we do downgrade from a buy to an accumulate because of the recent share price performance. And we didn't raise the target price, but we just kept the target price neutral, but the share price went up. That's why we downgraded it to an accumulate. Yeah. So that's all for Comfort. Now let's move on to the last one. Sorry, give me a moment to just. Yes. So sorry, give me a minute. Yep. Lastly, we're looking at Starhub. Starhub, the main highlight was the jump in mobile subscribers. So mobile subscribers, we don't really know the reason why, but it did jump up to almost a 10-year high. You can look at the numbers here. And this is it's not like a lot of the people or the customers are actually scrambling to buy new handphones or new postpaid service, but I think it's more of we think that it's more of Starhub being quite aggressive. So they are pushing for all these mobile subscribers, which is how they managed to get this jump up. And most of the growth came from MVNOs, which is a bit like Circle Life. And all these are very, really low-end pricing. And I think what Paul would say is that there is one thing that could be happening would be they are posturing ahead of a possible merger. There's been some rumors going on around, and this is also what Singtel said, where they are trying to position themselves to gain as much market share before the merger, where they look like they have the strongest market share. But this is really coming from the low-end market share. And for negative, the main negative is that the spectrum payment, again, it did hit Singtel, so it also will hit Starhub. It's very negative, again, as I would like to reiterate previously with Singtel as well. You can't really generate much revenue from spectrum, but there are also a bit of speculation also about spectrum, so it's quite hard to gain any net improvement on the bottom line with this spectrum. Okay, so we do maintain our FY24 forecast as well as target price of $1.29. However, we do upgrade from a neutral to an accumulate due to the recent weakness in the share price. Hence, we maintain our target price, but the recommendation goes up to an accumulate. And also any price repair from any consolidation will also depend greatly on the behavior of the competitors. Like some are worried about like TPG or Simba, who have come in to make very aggressive price actions because they both know that Starhub is trying to consolidate. Okay, now moving on to the next one that's all for the counters. We will now look at the macro. For macro-wise, right, the SIA passengers and as well as the capacity has improved, right? The demand has still very healthy. It's up about 12% year on year for October. Capacity is also up, but more interestingly is that the capacity is actually outpacing the demand. There's a slide on that later with a graph, so we'll talk more about that later. But this healthy capacity is very positive for both SIA Engineering as well as ST Engineering. Cargo was also up. It's very positive numbers, up 20% year on year. It shows very robust cargo traffic, and it's also positive for sets. Yeah, as for the private residential, there's new launches in October. It spiked up, about 262%, of 738 units. There's also another slide later, so we'll talk about that more later. So now moving on to the next slide. Yeah, so for technical views, it's really more of a review of the results. I spoke quite a bit about the banks earlier, right? But the main highlight being that the trading income was really boosted heavily by this the yen carry trade, and I think more interestingly, I'd like to point out that UOB, because the DBS mentions very specifically that they're going to give 3 billion of share buybacks, but the timeline's unsure. But UOB, they're saying that we are going to release some, and we're going to be very aggressive in managing excess capital of around 3 billion, but there's no news of when it's going to happen or how much is going to happen. Hence, I think that sort of upside surprise is what actually caused UOB to surge more than the other two banks. And then last but not least, OCBC they have a lot of excess capital, but they didn't give any indication of what they're going to do with it. For the telco wise, I think I spoke quite a bit on that earlier. For electronics also, it's really very weak macro from their contract manufacturers. So AEM has sort of bottomed but with AI, we see some sort of recovery, but it really depends on the major customer that they have. And lastly, for rubber gloves, this is really a precursor to Trump. So it shows the sort of the tariffs that they're going to put on, right? So they have given in the import tariffs for Chinese medical gloves, it has jumped from like 7.5% to 50% in January. So this is during the Biden administration, right? During the Trump administration, we could see this going up even higher, right? And there's also they're able to use some regulations where they don't need to get Congress approval to actually increase tariffs. So that's a bit of a worry where Chinese tariffs could go up even higher. As for the weeks ahead, our events, there is ST Engineering today, which is Paul is attending now. And the next big one would be on the 20th, which would be NVIDIA's results. Yeah, so they'll be keeping an eye on that as well. As for Corporate Insights webinars, tomorrow we have Lendlease, and 21st we have Pan United, and a few others the following week as well. So do sign up for these webinars to listen in. Now moving on to the next slide. Yeah, so yeah, this is the slides that we have on the cargo, SIA cargo, as well as their capacity. If you look at the SIA cargo, the cargo has sort of returned to even surpassed the pre-pandemic average of around 1%, so it's around 18% right now. And interestingly, also their capacity has also sort of improved. But what's happening now for the capacity wise is still outpacing the demand. So it's a bit of too much supply, oversupply, but the gap is still closing. If you look back the past few months, the gap was rather huge, but now the demand is catching up with this capacity. So we could see a further improvement where finally we will see a higher sort of a demand for the SIA passengers. And this is beneficial, of course, to SIA, and to SATS as well for the cargo. Now moving on to the next slide. Yeah, so I think this is the last slide. Yeah. So last slide, right? We're looking at the Singapore primary residential sales. So this shows the year-on-year average of the residential sales, right? It's as you can see that during COVID, and it took a really huge decline, which is to be expected. And but recently there was actually a spike in transactions over the last 2 months. So we going into 2025, we do believe that this will continue. There are basically more launches being released next year, so we could see this continuing into 2025 as well. This will be quite beneficial to those like counters like Propnex or maybe ERA, where the real estate agents. Yeah. Now, for the last one, the retail sales and inventory. So retail demand has been healthy, which is the blue line here. However, the inventory is still climbing above it. So that's also a bit of worry where we see a bit of oversupply and over inventory. Just to keep an eye out on this. Yeah, that's all I have, I think. Move to the next slide, please. Yeah, so that's all. let me hand it over to the rest of my colleagues to answer questions first. Well, yeah.
Yeah,
Thanks.
thanks a lot, Glenn. Thanks a lot for your questions too. I'll take on some questions now. First up, is Palantir too high to buy now? What about AMD? We don't cover Palantir, but I can share some insights. So last week, the Palantir shares jumped because there's announcements that it's going to be listed on Nasdaq. And I personally feel that there's a lot of hype because of the Trump presidency recently. So people think that Trump will spend more on US software. And also there's a lot of AI hype as well as the wars going on in Middle East. I mean the Ukraine-Russia war. So because Palantir software is also used in defense, so there's also a lot of hype going around there. So I do feel that if you really want to buy into Palantir, you have to be prepared to take on a very high risk. Yeah. As for AMD, yep, we do cover AMD. So AMD shares dropped last week because I think it's mainly because they announced that they are going to cut 4% of their workforce. And I think a lot of investors see this as a sign of weakness because their main competitor, which is Intel, they also have been cutting their workforce as their share price has been going down and they have been underperforming in the very recent quarter. So I think investors are seeing this as a sign of weakness. However, I personally feel that trimming their workforce is a good sign because this means that AMD can divert more resources to the segments that are actually generating more margins and shareholder value. For example, their data center and client segments are driving most of the revenue and profit growth of AMD. And the data segments consist of the CPU and GPU, and client consists of the PCs. And during their AMD's third quarter results itself, they actually raised their full year guidance for the MI300X GPU revenue to more than 5 billion. Previously, it was 4.5 billion. So I personally feel that the fact that they want to raise their guidance for this GPU segment and they are confident in raising this guidance, but at the same time, they are also trimming their workforce. I feel that they are actually diverting more of the resources into these segments that are actually driving a very strong growth within the AMD's profit segments. Yeah. So currently our target price is 170, and we do maintain a buy recommendation for AMD itself. Yeah. So that's the first question. Next question is, there's a question about what is the difference between accumulate and buy, which has more weight. So, for our firm's rating system, buy is for returns that have more than 20% upside, whereas accumulate is for returns that is between 5% to 20% upside. So, buy have a stronger kind of incentive compared to accumulate. Yeah. Okay, I think one last question for me. How does the government dormitory coming on stream in 2026 affect Centurion's performance? Yeah, I did see a news just I think yesterday about government launching more supplies of worker dormitories. So yes, we did take all these supply and demand dynamics into account, and we feel that government supply as well as the entire industry's supply of worker dormitory will eventually grow towards demand, and the demand and supply gap is closing. And Centurion also did guide that the rental rates will also moderate because the supply is going to catch up with demand. However, we still expect to see shortage going into 2025 because based on my personal forecast, I feel that supply will meet demand towards the end of 2025. Yeah, so that is the later part of 2025. So in the near term, I feel that occupancy for worker accommodations will still be high, and rental reversions will also increase slightly in the short run because there is a lagging effect. Because when the leases expire, the renewals for these worker accommodation contracts will last for 1 to 2 years. Yeah, so there will also be a lagging effect in terms of these rental reversions. Yeah. So I hope that answers your questions. I'll hand over the time to my other colleagues. Thanks.
Thank you, Iqbal. Let me take on a few questions. So, first of all, is who are Airbnb's main competitors and how are they doing compared to Airbnb? So, Airbnb, it basically faces competitions from hotels like Marriott's as well as other online travel agencies like Booking Holdings and Expedia. So if we compare the three, so the revenue and the volumes for all the three are more or less in line at about 10%, but the valuations and earnings growth they vary. So Airbnb is basically trading at a multiple of 31 times for 2025 forward P multiple, and the expectations for earnings growth are just 11%. Whereas for Booking Holdings and Expedia, they are currently trading at a lower valuations as compared to Airbnb, and plus they the earnings growth rate for these two companies are also higher as compared to Airbnb. Like for Expedia, the earnings growth rate is expected to be about 20% in 2025, whereas for Booking Holdings, it's expected to be at 14%. But in terms of valuations, Expedia is trading at 13 times as compared to Airbnb's 31 times for 2025 multiple. So as a result, we have a reduced recommendation on Airbnb. So moving on to the next question, among the Max 7 stocks, Nvidia, Amazon, Meta, Alphabet, and Microsoft, which has the most upside and cheapest in valuation and undervalued? So in terms of target prices and valuations, so Google, it has the most upside. We have a target price of about $240 on Google, and it's currently trading at about 175. So about 38% of upside is there for Google. And even in terms of valuations, it's the cheapest, and it's currently trading at about 21 times forward PE multiple as compared to the other Max 7 stocks. And we like Google mainly because there's still strong demand for digital advertising, and it's the third largest public cloud provider, and with the strong demand for GPU as a service, it still has strong growth forward. And also it has 90% overall market share in the search engine, and as a result it can leverage its AI digital ad capabilities over there. And in terms of valuations, like I mentioned, it's cheapest as compared to the other Max 7 stocks. So moving on to the next question, update for PayPal earning and target price. So for PayPal, the margins expansion is still the main story for PayPal. So it's doing these margin expansion mainly through two steps. First of all, it's reducing its costs and expenses through like layoffs and real estate consolidation, and reducing corporate overhead expenses. So and this is the first step. And second step, it's doing its margin expansion. It's mainly focusing on its high margin business, and also it has recently shifted its pricing strategy to price to value. And as a result, it's the focus it's has shifted on high margin businesses, and the margins have been expanding for PayPal. Like in the most recent quarter, its adjusted earnings per share, they grew by about 22% on a year-over-year basis. And overall, we believe that it should benefit mainly because of its global network and two-sided network effects, as it has a user base of over 400 million users. And also it should benefit from shift to digital commerce. And in terms of valuations also, it's a fairly valued, it's cheap, as it's currently trading at about 16 times forward PE multiple. And overall, for PayPal, we have accumulated recommendation and a target price of $90, and it's currently trading at about $85. So hope that helps. I would now like to pass it on to the rest of my colleagues.
Yeah, thanks, Ambrish. Let me try to take some. There's some questions a bit more specific ones, I think, asking about Singtel or Starhub. Yeah. Please just scan this QR code here. Join our B3 community. You can address it to Paul, and he'll be sure to get back to you. if you just put it in the community group, and I think he'll be able to give you a better answer than I can, because I'm just helping to cover him while he's away at the end of this briefing. Yeah, so I'll try my best to answer the banks one. I'll answer all of them. But the one on the other stock counters, I may not be able to answer some of them. Yeah, so I think there are two questions asking what's included in the bank's trading income. Yeah, good question. So bank's trading income is mainly, it's a bit like they do all have like a sort of a brokerage. They do the trading brokerage kind of side of that. So if higher volatility, if there's more trading, they benefit from that because they earn from the fees. And also another part of it is the customer related sort of treasury income, where they get related due to like some of like hedging and investment activity. So if that goes up, if volatility is high, that will also go up. So it's really due to they benefit when there's more volatility. Yeah, I hope that answers your questions. View on the three local banks, I did give that just now during when I was talking about the three banks. But basically, going ahead, we believe that this sort of lower rate cut expectations, it will be beneficial for the banks. But then again, with the share price all shooting up so high, right? I'm not sure how much further can it go, which is why we still maintain a neutral on the banking sector. Yeah, but I think the one surprise we could see is them being more aggressive in capital management, where they give back some of this excess capital that they have. So that would be a good surprise, which could see a bump up in their dividends or their ROE and their EPS. Okay, one here about the Singtel one. I think yeah, you could just send that to Paul, either through the community, or if you don't have access to the community, you can also send it to him by email. I think he'll be able to answer that. Which US banks would you recommend? Yeah, going ahead, I think the bank that will benefit quite a lot, right, from Trump's win I think all the banks will benefit, right? But the main beneficiary, I think, would be JP Morgan, right? Because they have their arms in almost everything, and also they are very dependent on the net interest income, net interest margins, right? So now when their rates are higher for longer, right, and lesser rate cuts, they could be able to turn around their net interest margins and net interest income and be able to sort of benefit from that. Another one would also be Wells Fargo. Wells Fargo could also improve. So Wells Fargo is very retail sort of bank, where they are really on the ground with the US consumer. So that could be a plus side for them as well. Whereas Bank of America, so we cover the three of them. Bank of America, with this, sort of higher interest rate environment, we could see Bank of America not getting as much growth from their wealth management side. Wealth management is a big part of Bank of America's revenue. So we could possibly see a bit of a slowdown in wealth management side, because now with a bit of the interest rates not declining as much, investors might not be pressured to move away from, let's say, the more safe, low-risk investments like fixed deposits. Okay, will OCBC CET1 be positively or negatively impacted? Wait, sorry, where did the question go to? Will OCBC... Sorry, just jump. Yeah, will it be positively or negatively impacted when the GE issue is resolved or privatized? Yeah, it'll definitely go down, right? It was about 0.8% percentage points in their CET1. So if it does get resolved or privatized, their CET1 will definitely dip. So it's currently 15.6%. Even if it dips, it will go down to below 15, let's say 15%. Right? 15% is still extremely high for the bank. They did specifically say that their optimal CET1 is 14%. So looking at that, they still have an excess of 1 percentage point, and that's almost, I think, around 2 to 3 billion of Sing dollars of excess capital that they have to return. Right? We did ask them directly, what are you going to do with this excess capital? And they said that give more details. They could give back, right? They could return this capital, but I think not much details are given, so we will have to really wait until the fourth quarter results. But that's really one of the upside surprises regarding their excess capital. They do have the highest amongst the three banks. Any idea on what are the sectors? Sorry, why does this keep jumping? What are the sectors? Hold on, sorry. Differentiation in terms of loans growth for each bank. Do each specialize in different sectors, hence less head-on competition? For example, construction, manufacturing. Yeah, the banks definitely do specialize in each of their own the loans, in terms of loans. If you look at UOB, I think is really the main outlier per se. They focus very heavily on SME. They're SME bank, right? They're very proud of being an SME bank. So, you know, SME banking for UOB is quite strong. Whereas for the rest, I think if you look at it overall, it's really quite similar. You know, they have a good mix of all the different sort of sectors in the loans growth. But I think what else you can look at would be the sort of the area which they are in, the region that they are in, right? OCBC and DBS are a bit more towards the China, Greater China, Hong Kong area, so which is why their loans growth might be a bit affected due to the macro environment and the macro factors that are happening in China. So they are trying to cut back on their China exposure. DBS is now pushing into like City Taiwan because of the acquisition with Citibank, sorry. So that's why they're trying to move away from the China. OCBC likewise is also, you know, cutting back on the they're not really cutting back, but they are trying to grow maybe a bit of outside of China. You know, they are trying to grow in the Greater China instead of just, you know, solely mainland China. As for UOB, they have very specifically said during the investor day that they are looking into the ASEAN 4 region, which is Malaysia, Indonesia, Thailand, Vietnam. Right, these 4 countries, surprisingly, the other 2 banks are not focusing on. So, you know, UOB is like the only Singapore bank that has a bigger presence in these 4 countries, and they're trying to expand very much into that. So all the banks are really focusing differently into each loans, how they're driving their loans, right? Each bank is focusing differently. So it's quite good as they're not trying to steal away, you know, market share from each other instead of, you know, just trying to grow independently. But I think the main thing, you know, if interest rates don't go down as much, right, the loans growth will not grow no matter where you are or what sector you are in, right? But what we're seeing is that with the rate cuts kicking in, loans growth is actually quite healthy. We could see it hitting, you know, mid-single digit by next year, and this will be helping to buffer the sort of NIM margin compression, which we are already seeing and very likely will continue to see in 2025 as well. Yeah, one asking about sorry, give me, why does the thing keep jumping? One asking about the TP for DBS, why is it lower than the share price? So there's a reason we have a neutral. So we have a neutral on DBS, and we have an accumulate call on OCBC and UOB. So someone is asking earlier, I think I saw a question where they asked, what is the difference? Is accumulate or buy better? So for us, a buy call would be a stronger call, right? We are looking at returns of 20% upwards, whereas accumulate is around 5 to 20%, and then neutral is, you know, -5 to +5%. For DBS, right, which is why we have a neutral call, because we feel that there's not much more room for it to grow. Whereas OCBC and UOB, based on our models and our forecasts, we believe that the share price has still some room to grow. Yeah, hope that clarifies. Yeah, so I answered this one about the. So what is the price catalyst for SGX? Is it a buy looking at dividends? How about iFast? Any outlook for it? Yeah, for SGX, looking at the dividends wise, no, it's not a buy. Yeah, dividends, it's quite, they have this very prudent dividend policy where they will not lower absolute dividends, but they don't peg it to their earnings, right? So if SGX is a very good half or a full year, half year, right, which we will be coming up soon. I think in January they'll be releasing the results. They will not increase dividends in line with their earnings, right? The dividend policy is separate. So dividends, they are assured that it will go up regardless, or it will not go down, at least if earnings go down, but they will try to pay like sort of a slow and steady kind of increase. So they're trying to maintain it. They don't want it to go down below what they have given, right? So that is not their policy. So if you're asking me whether is it a buy looking at dividends, not really. But if you want to look at their earnings, how well can they do, then yes, clearly, which is why a lot of the investors have also felt so, and SGX share price has gone up because of the volatility and the volumes that have all been increasing rapidly, and hence we see this a huge jump up in SGX. As for iFast, it's because I think what's going on with iFast, we don't cover iFast, but just a bit of my view and outlook on iFast. The Hong Kong e-pension business has been priced in to the share price already. So, although they do say that, it's increasing by that double digit every year, it's really been priced in, right? So there's a bit of a fall off from that side. But what's really going to be the push factor, the growth factor for iFast is that they're a global bank, right? They are trying to still grow, which is why it's loss making. But currently they don't really give any indication of when is it going. They did say the first quarter of 2025 they'll try to make it a profit, a positive, right? But I don't know if that will really come to fruition, and how much profit, how much bottom line can it contribute. That is still a question that is unanswered. I think even they themselves are not very clear on that. Okay, yeah, someone asked about the telco. I can answer this one on the spectrum, right? So basically, this is the government, I think in 2017, right? They made a 1.14 billion sale of airwaves, which are to be used for delivering 4G mobile services. So it's really just to enable them to continue to provide the same the good service that they are providing. So all the telcos actually have made this payment. I think Singtel is the highest amount, around 500 plus million for they gave sort of a limited amount of, if you know how the airwaves work, they give around a limited amount of spectrum which they can use, right? This is for the 4G mobile services. So they all just bid, for this amount that they can use in order to grow their capacity. But what I think we are trying to say is that it's very hard to say that I pay this much for the capacity and then to charge consumers higher, which is why it doesn't really benefit the bottom line. But they still have to do it, because otherwise if they don't do it, then they cannot grow the capacity, they cannot grow the number of mobile users that they have. So it's a bit of a, they don't do, they lose out, but they do, they also lose out. So right, they have to do it. As bottom line, I think it just goes into cost line, where they have to pay for this extra bandwidth, and it's just a cost item that they have to do. Yeah. So I think that's the main gist that we get out of this spectrum payment. Yeah, okay, another one here regarding digital fintech stocks and US banks. So they're asking, is there a big jump in most of the digital fintech stocks, Zip, Square? Yeah, so can you shed some light on this? Yeah, I think it's really due to the Trump win, right? So now it's basically getting better for banks, any kind of bank in this environment, right? Their margins will not be as compressed, hence that's why we saw this huge jump in all the banking kind of related stocks, right? And what's my outlook on JPM? I think I mentioned it earlier. They will probably they'll be able to benefit the most from the higher for longer rates, this interest rate environment, as compared to the other two, right? Because they can interestingly they are able to cut down their costs quite effectively, right? It might also be due to the fact that they acquired the First Republic Bank previously, so they just took on this whole load of deposits, right? And also, them being the largest, they are able to it's akin to DBS, where they are able to give you a low deposit sort of cost, right? Like low deposit current account rate, but you will still stick with them because you feel that you feel safe with JP Morgan, right? Like how you feel safe, maybe like safer with DBS. Hence, you just go with them, even though the rates that they're giving is low. Hence, they are able to garner this sort of a lower cost, which helps them to improve their net interest margins. So being big in that sense for a bank, and it's actually quite beneficial, where they have a lot of low cost deposits, and in return they can put it back into higher yielding interest assets, and then they can earn that spread. So DBS is doing that, and I think JPM is also going to do that, and they are really doing that, which is why they will benefit, probably be the most beneficial for them in this kind of environment. What is the TP for SGX now that's moving up? Yeah, we are still reviewing the target price, so I think it's below now. Our target price it's $11. Sorry, $10.78. It's currently at $12. Yeah, I'm aware. So we're going to review the SGX target price. But like I said, right, I think the main kicker is that if dividends don't go up, then what are they going to do with all this excess earnings that is coming in? If it really comes true that the volumes have all increased, then earnings will also go up. Yeah, I think we will hope for some good news in the first half FY25 results, which they will release in January. Okay, there's one more about Singtel. I think yeah, you could ask that in the community group and just point that towards Paul. He'll be able to answer that better. One more, can you consider covering Citibank? Yeah, I'll try to do that. Yeah, but no promises. We'll definitely look at it. Yeah. Thanks. Do you think regional banks will benefit or any consolidation of regional banks under Trump? I think it's too early to tell right now whether or not there will be any sort of consolidation for regional banks. But I think it could be it could be it could be a bit hard on the regional banks, right? Because they do have this large amount of allowances, NPLs, because where their customers unable to pay back because of the high interest rates. So with Trump's win, inflation is interest rates are gonna remain high. So whether or not they will be able to sort of lower their NPLs, and maintain their balance sheet, healthy balance sheet. Yeah. So they will hopefully they will be able to pull through. Otherwise, we might see another case of like First Republic where they can't handle it anymore, and then it just gets absorbed by JP Morgan or another big US bank. Do you expect special dividends from OCBC with GE privatization? I don't know. I think nobody knows. I think honestly speaking, I think OCBC also doesn't know, right? Whether or not they're gonna give any special dividend. Like I mentioned earlier, even if they do give back, even if they do privatize GE eventually, right? With and when they do it, they will still have such large amounts of excess capital. And will they give it back? I really hope so, because otherwise they're going to be facing questions from us analysts every quarter about why are they not doing anything with excess capital when both their peers have mentioned something and that they'll be doing something, right? So, and then investors will also be asking, why aren't you giving back to us as shareholders? You can just go to UOB and DBS, where they are actually giving actively and aggressively giving back capital to shareholders. So I really hope so. Whether or not I expect it, I'm on the fence on this. Yeah, I think they will do something, but how drastic it will be, it depends on their board also, whether or not they agree to that, how much they want to give back. China. I answered the one about iFast. Do you expect more downsides on OCBC and DBS earnings since they have exposure to China going forward, with Trump expecting to impose 60% tariffs? Yeah, which is why I think they are also actively trying to cut back on their China exposure, right? They are not expanding anymore, right? They are not trying to increase the loans or volumes in China. They are focusing heavily on their fee income, wealth management sort of portfolio. And in China, they are really only looking at if you look at the China portfolio, right, they are looking at sort of offshore China kind of thing. So Chinese money that is coming out of China, right? So the mainland onshore mainland China, they are really trying to contain it, and they realize that the situation isn't really as desirable. And now with Trump's win, right, it's going to be even worse. So I think they are cutting back and focusing on other sectors which they are strong in, and which they of course see growth in. Okay, let me just do some quick ones first. Oh yeah, still got a few. Do you expect interest rates cuts to slow or pause to curb potential inflation in view of tariffs going forward? How will this benefit or not benefit the banks? Yeah, so the expectations is for interest rate cuts to slow down slightly, right? In view, that with Trump's win, inflation will still remain quite persistent. And how will this benefit? This will benefit the banks because firstly, they if interest rates is high, they'll be able to get a better spread, which is what improves their net interest margins. But on the flip side, how will it not benefit the banks is that if interest rates remain too high, then loans growth will not see that recovery which we are expecting of mid to high single digit, right? And then this will, of course, negatively impact loans growth. And also what we have seen is that their fee income has been very strong. If interest rates remain too high, some investors, a lot of the investors might begin to move away from the fee income, wealth management, investment products, and then back into fixed deposits, because fixed deposit rates have maybe gone up a little bit, right? So they might start to move back away. So fee income could be slightly affected, but definitely, I think on the whole, we are expecting that the net interest margins and net interest income improvement will be a good benefit for the banks moving into FY25. Yeah, okay, I think that's all for me. Someone asked about Michelle asked to show the earlier slide on Singtel. Mel, could you just move back to the Singtel slide and then just show it for a few minutes, and then we can, yeah. I'll hand it over back to the rest of my colleagues. Thanks.
Yeah, thanks. Let me take on some. Well, hi there. With the Trump 2.0, there's a possibility of increased inflation risk and thereby impacting interest rate risk. What is your viewpoint on impact to prime US share price? Yeah, so for that, previously the market was expecting like 4 rate cuts next year and one more in December, so total 5. But because of Trump's election, it seems like it's been scaled back to about 3 total rate cuts until end 2025. So that's definitely more restrictive level. So definitely that will impact the REITs, and prime US will also be affected. Yeah, and because previously when there were so many rate cuts, the expectations were that cap rates will likely stabilize already. But that might not be the case as well for prime because of the recent transactions that saw like Manulife divest 30% the asset to discount to valuation and the lack of bank funding as well. So all that will impact prime. So yeah, so prime definitely will be impacted as well, even though from the capital management perspective, they do have about 61% that are still hedged to fixed rate. So the increase in the borrowings that they recently refinanced with, so that is been kind of relatively shielded from the high interest rate because they previously already hedged a portion of that. So but going forward after the expiry of those hedges, yeah, it really depends on how many rate cuts. So definitely they will be affected by this higher interest rates, or rather lesser rate cuts going forward. Yeah, so that's in line with all the REITs will also be affected by that. So that's also why we saw a lot of the REITs retrace, or rather since the election of Trump, a lot of the REITs, the share prices fell back. After a lot of them also returned the gains that they saw in the previous three months, where they saw like a 15% share price increase across the whole REIT index. So after Trump's election, we saw a lot of the REITs give back the gains. Yeah, so the best REIT to buy now, that's another question. We think our top pick now is still Cromwell because of their high dividend yield and very resilient portfolio. And the outlook for them is also very promising, with high occupancy and rent still improving, as well as their AI is paying off. We've seen rental reversions 40% for some of the stronger assets, and also their shift to light industrial logistics also will help to benefit them. And not to mention that their rents are tagged to CPI, so they'll benefit if inflation remains sticky, so they'll get more income as well. But the base factor is that their balance sheet is very strong. The gearing is 40%. Yeah, and they're still paying a high dividend yield of upwards of 8%. Yeah, I'll leave the Lendlease question to Meow Meow. Do you foresee any growth or price trend in UL considering property performance? Yeah, so for Mirror Blue, it was 50% sold on launch, so now probably slightly higher. But we do not cover UL, so I can't really comment on the price growth. I'll leave the TA section to Zane to do some technicals on UL, so that might be helpful. Yeah, apologies for that. The recent unit price weakness for AIM CPAC REIT. Bowsprit, yeah, we don't cover Bowsprit, and maybe Paul might have some insights, but it's not here, so perhaps you can ask in P3 or you can ask next week. But for AIM CPAC, I don't see any company specific factors that affected the share price. I think it's more like the whole macro, because AIM CPAC, their performance for the first half financial year was still very strong, like that 17% rental reversions. Yeah, and their DPU also increased. Yeah, so that's still such strong. So yeah, it's more macro, I would say. The impact on REITs going forward with Trump trade, yeah, definitely impacted by the rate cut trajectory. Lesser rate cuts, fewer rate cuts will definitely mean higher interest rates for REITs, which is definitely a bad thing. So yeah, that was why we saw some weakness in the REIT share prices. What do you see current REIT prices and general view? Yeah, so generally, for REITs, we still think there is upside because after all, there's still some rate cuts going forward. Just that it's not as fast as originally anticipated or originally expected because of the Trump inflationary policies. But as a result of even like perhaps one more 100 basis points cut until end of year 2025, the REITs will still benefit from cheaper finance expenses. So as a result, the DPU might still rather likely to improve, because we've seen a lot of the REITs, they have already repriced all their loans at a higher rate, and any rate going forward. And going forward, they will benefit from the lower interest rates, especially with some of the fixed rate debt falls off. Yeah, so we think the REITs generally across the board will still benefit, even though it's a slower rate cut path. Yeah, so we still see some upside for the REITs, yeah, across the board. Why is Escort pulled back so much when the results appear to be good? Any negatives? Yeah, I don't really see any negatives for Escort near term. Perhaps maybe just a little bit of the growth in RevPAR is slowing down because from the very high base in 2023, as well as in some geographies like in Singapore, we notice a bit of down trading where even though the tourist numbers are coming back, tourist arrivals are still increasing and there's still potential for growth because it's not yet at pre-COVID levels. But the spending per person or per tourist has definitely shrunk, as well as the days that each visitor spends in Singapore has also fallen to 3 days from about 3.5. So yeah, so these are some weakness, but this affects the whole macro. Yeah, but specifically for Escort, yeah, I don't see any much weakness. The share price weakness is probably just a macro. The interest rate, the interest rate cut cycle, that lesser interest rate cut, so that really impacted all of the REITs, like I mentioned. Darren mentioned prefer Cromwell REIT. Which do you prefer, SGD or Euro? Yeah, so for Cromwell REIT, right, they have two counters that you can trade. So they have the Euro and the SGD. Actually, both is the same, it's fungible as well, but I would recommend you trading the Euro counter because it's more liquid. there's more liquidity and more trading volume as well. The SGD counter, there's not much trading volume. Yeah, but basically it's fungible for both the SGD and Euro counter. Yeah, there's one the outlook and TP for CapitaLand. Yeah, CapitaLand Escort, we have a TP of $1.04. It's a buy call. Yeah, I spoke a bit about it earlier. We also like it because of their good track record. They've been divesting assets at a Z yield of about 3% and acquiring assets with a higher yield of maybe 4+%. Like in Japan, they also divested one at 0.3% exit yield. Yeah, the reasons they cited that they can divest at such a good premium to valuation as well is because the buyers, they see potential in the asset and they can change the use to like maybe a more luxury or a different concept that can that you'll see an increase in valuation, which was why they are willing to spend that 50% more, pay 50% higher than valuation for a lot of the Escort's recent divestments. We saw that kind of sales price, like 50% premium to valuations. Yeah, Keppel REIT do not cover, but for Keppel REIT is their rents. We still see perhaps another year of high single-digit rental reversions, because even though there are some supply that's incoming, or rather IOI this year came on stream. Phase 1, Phase 2 is still upcoming, but that Phase 2 is much smaller. But Phase 1, we think by end of the year will probably be around 80% field ready. So it's currently around 60%. We think 60% occupied, and another 20% is in advanced negotiation. So probably around 80%. And the rents that IOI demanding of $14 to $16 per square foot, which is much higher than the average. And Keppel REIT also, their passing rents are lower than the market rate average. So we also think that based on the fact that their in-place rents are still lower than market rate, they still have some potential for slight positive rental reversions. Yeah, so that's the outlook for Keppel REIT. Yeah, we don't cover Keppel REIT, so we do not have a target price on that. Yeah, but if there's time, maybe Zane can do some TA. Yeah, we left 20 minutes. Maybe I'll hand over to Mel to answer some questions before handing over to Zane. Yeah, thanks.
Thank you, Darren. I'll take the 17 Life question. So some updates for 17 Life. They reached a settlement with the musical copyright organization and expected to pay US $13.6 million. And we expect this to hurt their full year results. But this will come after operating profit as a one-off expense. And they also recently acquired a Japanese company, Valuetronics company, as part of the initiative to expand on Valuetronics presence. Yeah, so there will be like 140 Valuetronics streamers to come on board, and we expect the revenue to triple for 17 Life for Valuetronics segment. And for the Lendlease, what are the main reasons that Lendlease is divesting GEM's office space, and how far can I help them? What are their chances in finding buyers? So the divestment of GEM is a solution to lower their gearing ratio and also to repay some of its perpetual, as there's like 2 more due next year. So this will definitely help them through lower gearing to at least around like 35%, and also to a very healthy level, and also is largely favored by the investors. And they can also have some buffer to repay some of the perpetual given the higher for longer interest rate after Trump was elected. Yeah, so why GEM property is because Lendlease believes, because that is a single tenant office building, and they can't really have enough synergy or additional footfall, yeah, by keeping that property. And it also is favored by in-state investor, since like they believe it's more like a fixed income asset to them, since it's occupied by the government tenant, and they have very stable income and also rental reversion, yeah, which they have rental review every 5 years. Yeah, and they are engaging with more than 10 prospects but the offer they have been getting so far is below the valuation, which is 450 million. Yeah, so they are negotiating to get a higher offer. Yeah, so I'll hand over to Zing for technical analysis. Thank you.
Thanks, Manuel. I'll move on to the technicals. I'll share my screen. Yep, so I'll start with the Singapore and Hong Kong questions first, then if time permits, I'll talk about the US one. So first question is on Yang Zhejiang Financial. So looking at the chart, I think continue to find some support around the 38.5 to 39 cents support level. And today is retesting this breakdown level at 40.5 cents again. I think if price is able to hold, let's say 40 cents, there is a chance for some rebound. Especially when price is trying to break above this short-term downwards resistance line currently. Yeah, so potential upside could be towards 42 cents to 42.5 cents area, which was this resistance previously. Okay, then next one is Hong Kong Land. Also for Hong Kong Land, I think it's likely to consolidate for a while. Some pullback recently and a bit of a rebound. Resistance currently is around the $4.75 to about $4.80 this breakdown level over here. Then support is likely coming from this swing low around 435 to 440. So I expect some sort of consolidation for the time being. Okay, next one is 9868, which is Xpeng. So for Xpeng, price currently doing a bit of a pullback, but I think it's nearing some support level which could rebound from. So I think over here, this previous horizontal resistance around 47, which was around $47.80, as well as this upward support line over here, probably around 46 to 47, which could provide some sort of support in the near term for price to rebound. And then resistance will be a recent breakdown level around 55, 57 over here. The next question is on some more Hong Kong counters. 939, which is China Construction Bank. So for China Construction Bank, I think generally is likely still in the consolidation phase. So previous resistance at 570 to 580 area is still holding as a support. And key resistance over here is still around 620 to 630. So I think we'll likely still see a bit of a consolidation near term. Although there's some slight weakness where price was consolidating over here at a higher level with support around $6, and there was a breakdown recently. Today is doing a bit of retest, so there could still be some sort of a resistance at $6 level for now. Next question, 9618 JD. For JD, I think for now still seeing a bit of weakness after there was a breakdown below 149. Currently testing a strong support level around 128, a bit of a rebound. But I think overall, like the downtrend is still likely to persist. I think next support level below is likely around 121. And short-term resistance for now is likely to be around this 139 level, which was a previous swing high, which is retesting today. This is on CTL Hospitality Trust. So for CTL Hospitality Trust, I think price has pulled back quite a bit towards near this previous swing low level around 85.5 to 86 cents support level. So I think over here price should see some sort of bounce from this previous swing low. Then current resistance, there's some resistance around 88 cents, then followed by 90 cents for this counter. The next question is on SRT, which is CSOP IH S3 ETF. So this, I think, yeah, we're seeing a bit of a weakness in the S3 index for now. Price failed to hold at this previous resistance at 77 cents. So some resistance over there. I think price could still see a bit of weakness in the near term. Next support level downwards would be around the 73, likely at the 73 cents mark, then followed by around 71.5 cents level. So yeah, for now we might still see the downtrend continue. With a bit of consolidation, maybe closer to the 73 cents level. Next one is on venture. So for venture, I think still in a bit of a downtrend recently. A bit of a holding for a while at this previous support level at $12.60. But I think we'll likely still see some weakness going ahead. Near-term resistance will probably be around $13 to about $13.30 about there. Then next support level below will be around close to the $12 mark. So I think for now we're still seeing some bearish downtrend for this counter for the time being. Next one is Mapletree Industrial Trust. So I think for this price pull back towards previous range consolidation resistance, which was at $2.26. So seeing a bit of a consolidation over here. I expect a bit of a consolidation or a slight rebound, maybe retest this 235 breakdown level, which is likely to act as a resistance. Also, there's this downwards resistance line for timing. So overall, still in the downtrend, but for now, we might see some sideways consolidation or a bit of a rebound from this current support level. Then the next support level after this, should the price breakdown will be around closer to $2.18 level. And next one is HST, which is the Lion OCBC HS Tech. So for this, I think we're likely for now we are likely seeing a bit of a consolidation, which is some support at this 72 cent swing level, but resistance still holding out at this breakdown, which was at around 80 cents. So yeah, we have a consolidation for the time being. If price breaks below 71 cents, then we might see some further pullback towards next support level around closer to 67 cents to 68 cents about there. Next one is Meituan. Yeah, for Meituan, I think for now is holding some support at this swing low of 168 over here, but I think overall still we're likely to still see some weakness in this counter with the recent breakdown below 180 to 183. This range level over here, which is likely to act as a bit of resistance. And then should the price break below 168, then we might see some further weakness towards next support level closer to about 147 to 151 over here. Then next one, Alibaba. Alibaba, I think we're still seeing some weakness for now. Price still breaking below some support levels recently at 94 as well as $90. So I think we could see price retest the next support level, which is at around 84, which was this prior resistance, this resistance consolidation over here previously before price went up. So over here, I think price should be able to find some sort of a support over here at 84. Then short-term resistance is at 90 for the time being. The next one is JD Logistics. For JD Logistics, I think for now we could see some further weakness, I think, because price tried to break above this $15.40 resistance previously. Then did a consolidation over here, and then last week there was a breakdown below this support level. So I think we could see some bit of a downside for now to maybe retest these lower support levels at around 1360, then maybe around 1280 next for there. One is on China Resources Gas. Yeah, for China Resources Gas, I think price, there was also weakness recently as well. Price failed to hold this $30 breakout range resistance breakout previously. Yeah, it just did a consolidation and there was a breakdown recently. I think we could see some further weakness to test some lower support levels at around 27.20 next. Then next support level down is around 25.50 about there. The next question is on Silver Lake. Silver Lake, I think for now, still nothing too much, just consolidating a range of resistance at around 37.5 cents to 38 cents if you will. Then for Q&M, the Q&M, I think price has actually pulled back to this prior range resistance level around 28.5 cents. Yeah, we also have a buy call, technical buy call for this counter today. Yeah, so I believe that this previous range resistance should be able to hold as a support for price to rebound over here. Yeah, since overall, since November of last year, price has been steadily trending upwards with higher highs and higher lows, forming range consolidations along the way. So I think price should get some support over here for this from this level. Next one is on ComfortDelGro. Yeah, for ComfortDelGro, I think for now, likely we're still seeing a bit of a consolidation. Yeah, price some positive signals that price retested this 142, then there was a rebound, then managed to hold above this breakdown level at 147 over here. So I think for now we might just see some consolidation between 147 to the resistance at 153. So some sideways consolidation. Next question is STEC. Yeah, so for STEC, I think overall price looks like starting to consolidate a little bit at a support level at 67 cents, which is a prior range resistance. Yeah, so if you can hold this level, I think the key is to see, if you want to see some sort of recovery, price must try to break above this 69.5 cents down level here. Then we might see some sort of bounce. Yeah, but the resistance above 69.5 cents will be around 72.5 cents also. So I think for now, maybe some consolidation if you're able to hold the recent lows. Then if you continue to break the recent lows, then I think next support level will be closer to about 65 cents, which was this previous range support back in August last year. And then next one is on Franklin. So I think Franklin for now, price looks like it's consolidating, holding the support level for now at 116. Then resistance is at this 126 level. So it just has been just consolidating a range for about a month. And then overall still trending downwards. If it breaks below 116, the next support level will be likely be this swing low at 112. Then next one is TA for the three local banks. Yeah, so first up, DBS. I think DBS likely just do a bit of a sideways consolidation for now. Price last week rebound from this $41.20 this level over here, and then some result at 43 for now. So I think just maybe some sort of sideways consolidation for now. And for UOB, I think something similar also. Just price starting to consolidate. All the local banks made these gains recently. So some resistance still at 37 for now, but I think support, some intermediate support will be around 35.50. Then next will be the next support level will be the recent swing low at 34.50 about that. For OCBC also similar as well. Price rebounded from this level at $16. Then some resistance for now will be around 16.60. So some sideways consolidation for the time being as well. Yeah, I think it's about one. Sorry, I'm going to take on all the questions in view of time, but feel free to post your TA questions in our committee group, and I'll take it over from there. Or if you're free tonight, I have a UST webinar tonight at 8 to 9:15. You can feel free to drop in and ask your questions as well, and I'll be happy to answer. Yeah. So I think for now, I'll hand over time back to my colleagues if there are any more questions before closing the session. Thanks.
Yeah, I think I see some questions on Thai Bev, you know, and Sheng Siong. Yeah, I think all those are for Paul. So you can just direct that to him, you know, on the P3 app, the community app, then he'll be sure to get back to you on those. Yeah, there's one more on C as well. The analyst, Helena, is not around today, so just do drop her an email, or again, just put it in the P3 community app and we'll get back to you. I think that's all the time we have for today. Thanks again so much for attending our webinar and our 11 a.m. call and spending your lunch hour with us. Yeah, we hope to see you again next week and have a great week ahead. Okay, thanks.